And joining us, the man with the hit new Amazon book, Sean Mullaney's here. How are you, man? Were you surprised when you saw that you were number one?
It is a number one new release. Pleasantly surprised. Absolutely. I think there's just a lot of interest in this. Folks are thinking about self employment, thinking about side hustles. And that's where I and my book step in terms of the tax and retirement planning.
I think it's great to see that many people interested, especially with all these recessionary signs that we've seen. So many people struggling. A lot of people don't know this is a great time of opportunity. Like if you can do it, this is when great businesses are made. But I want to start where you start. You start off like any self-respecting author, Sean, by talking about Ron Popeil, right? Because you got to start off with Ron Popeil. Tell us what Ron Popeil has to do with solo 401ks and retirement plans.
So Joe and I are dating ourselves, but there was a great infomercial for what was it, the chicken roaster, chicken rotisserie roaster that Ron
Yes.
Popeil used to sell. And he said all you had to do was set it and forget it. And that was my experience with 401ks at work. I used to work for Big Four Accounting. I worked for the IRS for 3 years. I had the TSP, the equivalent of the 401k. Basically, what would happen is you'd get an email from HR. You started the new job. Here's the 401k plan. Go to this portal, make an investment allocation election, make a contribution percentage election, and you set it and you forget it, right? And 401ks at large employers are great. But then later in my journey, I did what Joe did. I went out on my own, right? I became self employed. And when you're self employed, especially you're just working with yourself and for yourself, no one from HR emails you and says, hey, here's the 401k plan. Go pick out some investments. Tell us your contribution percentage, right? There's no set it and forget it. So you have to become the manager. You have to be active. But with that increased responsibility in terms of planning your own retirement, I think there's a whole lot more increased opportunity.
Well, you show us how the opportunities changed over time, right? The very first chapter of your new book goes through some of the history of where retirement plans have been. It feels to me like it's getting better, Sean. Is that true?
I think that's very much true, even for the large employer 401ks, right? My experience has been that large employer 401ks are improving in terms of investment selection, in terms of expenses. That said, they're certainly not perfect. One of the nice things about the solo 401k is you are in the driver's seat, right? So you get to pick the financial institution, right? You find your favorite financial institution that has the fees that you like, the investment options that you like, and you get to decide, okay, this is going to be my financial institution for my solo 401k. These are going to be the investments that I'm going to invest in. And then you also get to flexibly decide what's going to be my employee contribution to my own solo 401k. And even better, what's going to be my own employer contribution to my solo 401k. A lot of folks don't realize when you're self employed and you have a solo 401k, you get to make two separate contributions. You get to be both the so called employee and you get to be the employer.
You get to match yourself.
Absolutely. And you decide the matching contribution percentage, right? It's great working for a large employer and they say, well, up to the first 6% of salary that goes into the 401k, we'll match 50 cents on the dollar. That's fantastic, right? That's good. But say your salary is $100,000, right? That means 6% of 3,000 of $100,000 is $6,000. 50% of that is $3,000. So large employer puts $3,000 into the 401k. Great. What about a solo 401k? Well, if you had 100,000 of self-employment income, the rules say you can put up to 18,500 and a little change in there as the employer. So you might be able to get six times the
Wow.
contribution as an employer when you're working for yourself. It's an advantage of self-employment.
Is it so? I mean, based on the title of your book, I think you definitely are pulling people toward or nudging people toward the solo 401k because Sean, there's you can't set and forget it because there's so many different options. I can go with a SEP, I can go with a simple, I can go with the solo 401k. Like, why would I go with the solo 401k versus any of these other things that I could do if I'm self-employed?
Yeah, so you mentioned two great options, right? The simple IRA, the SEP IRA. Those have been out there for many years, and folks have successfully built up tax deferred savings through those vehicles. Two main reasons I'd say, though, the solo 401k for most users, for most solopreneurs, is going to be a better option, or one, significantly increased contribution limits, right? The SEP IRA does not allow employee contributions. And then the simple IRA tends to have very low employer contributions, also has lower employee contributions. The contribution limits are so much higher for most solopreneurs when they go with the solo 401k. So that's the first main reason. And then the second reason is the availability of the so-called Roth option, right? So folks in personal finance are familiar with this traditional versus Roth debate, and there's no one answer, and my book doesn't aim to resolve that question. It provides a few insights on that question. But I will say this, for many Americans, it's a good thing to have at least some optionality in terms of the Roth contributions. Solo 401k offers Roth. Simple IRA, SEP IRA today do not offer Roth contributions.
Obviously the word solo is in here. Can I set up the solo 401k if I bring on 2 employees? Let's say I've got just 1 or 2 employees. Is it gone, or can I still do it?
Yeah, great question, Joe. And the answer is you have to go through 2 filters, right? The first filter is the tax rules. That's what Congress and the IRS make up. And they basically say, look, if you have employees for 1,000 hours or more a year, and by 2024, that's actually going to sort of go to 500 hours a year or more, you cannot do a solo 401k. All right, so that is a limiter, a governor. That's the tax rule. Then you also have to go to your potential plan provider, and they can have a separate rule, and some do. They may say, you know what? We understand that tax rule, 1,000 hours a year and then 500 hours a year starting in 2024 if they've worked for 3 years. But some plans say if you have a W-2 worker for 1 hour for a year for any amount of time, you can't use our solo 401k. So there's that tax plan filter you have to go through. And then you also have to run it through the plan filter, the tax rule, the plan rule, as I refer to it in the book. And what you need to do is when you're thinking about setting up your solo 401k, you need to look at the various financial institutions and say, hey, what are your features and what do you allow? Some financial institutions say, yeah, we just go by the tax rule. We're fine with that. Other financial institutions say, you know what, we're a little more strict. We'll only allow you to have this solo 401k here if it's just you and your spouse. They generally allow the spouse, but the second you have 1 hour of any other employee, no solo 401k. So you absolutely have to think about this in advance, thinking about what is your operating situation and what does the financial institution allow.
Well, I love that, because that brings up another question, which is you don't just have to think about what they allow. You got to match it to what you want to do, which means you got to think about the future, which we should be doing anyway, right? We should be thinking, what do we want this to be? Do I want it to be me and just one other person? Or do I want to turn this into a big business later? Like, you got to have some of these visionary discussions with yourself.
Absolutely. So Joe, the solo 401k is a great tool. It is not for everyone though. And there are going to be plenty of solopreneurs who want to become more full entrepreneurs, who want to build scope and scale and start bringing on folks. Now, there are options available to those folks as well. Things like simple IRAs, things like safe harbor 401ks. Now, that can be an increased commitment because now you have employees you need to look out for and protect their interests. But many solopreneurs are like me, right? We're not looking to hire folks, right? We're content doing our jobs, and at least for now, having scope and scale. That basically means we're going to be a 1-woman, 1-man operation, or maybe we'll work with our spouse. That's a nice feature of the solo 401k. You can actually add your spouse pretty easily if he or she does work for your business. So yeah, absolutely, Joe, that this is a great tool in the toolbox. It's not for everybody though.
But I think you bring up another point, which is and I don't know this, so I'm going to ask the man, Sean Mullaney, can I, let's say I got a job and the job sucks, right? The 401k sucks. I have a horrible 401k, but I have this side hustle I've been developing, right? And you've got a whole chapter in your book around side hustles. Could I set up my own solo 401k there with options that are much better than my job at work, and now essentially reach my contribution with funds that have less egregious fees or things like that? Like, can I really flex my side business?
100%. for many solopreneurs, many side hustlers, that's going to be a great outcome and a great way to proceed.
Oh, sweet.
So what am I
That's
talking
sweet.
about?
Yeah.
Yeah. So what you could do is you could say, oh, I'm at large W-2 employer. They don't have a great 401k, but what they might have is an employer match, right? So your tactic could be this. All right, at work, I'm going to contribute to the 401k to the extent needed to secure the employer match, because that's instantaneous return on money, right?
Yeah.
That is a great thing. So why don't we pocket that? And then what I'm going to do is on my side hustle, I am going to open up a Roth solo 401k, traditional solo 401k, whatever it might be. And I'm going to contribute to that and maybe max that out, because there I get to pick the investments and the fees and all that good stuff. The one thing you want to keep in mind, though, is those employee contributions need to be coordinated, right? So maybe you just need to put in $5,000 at work for the large employer to get the full match. Okay, great. That means your employee contribution for your side hustle is capped. This is 2022. We'll use the 2022 numbers. In that situation, it would be capped at 15,500. Up that by another 6,500. 6,500. So about 21,000 in that example. If you're 50 or older, right? So you have to coordinate, because that 20,500 limit is per person, not per 401k plan. So if you did 5,000 at work, get the employer match, great tactic. And then maybe we can go up to that 15.5 for our side hustle for the employee contribution to our solo 401k.
But it's on you to do that math.
Absolutely. It is on you. And, there are ways to correct excess contributions. I talk a little bit about that in the book, but you want to do the planning up front so we don't get into that situation where we need to make corrective action.
I want to ask you two more questions. One is chapter 7, maybe is the sexiest title of any chapter you've got here, Sean. It is, listen to this, everybody, the qualified business income deduction in the solo 401k. That is cleverly worded.
Yeah. So, Joe, I like to say my book is a tax planning book. It's not a tax rule book. But that said, if we're going to do some tax planning, we do need to think about a few tax rules. Qualified business income deduction is a great feature for solopreneurs. It allows a 20% deduction against income for 20% of, they call it your qualified business income. Now, it has some complex interaction with the solo 401k, because if you do the traditional solo 401k contribution and you deduct that, you may actually reduce this qualified business income deduction.
Oh,
so there are two ways to resolve that. One is maybe you do a Roth solo 401k instead of a traditional deductible solo 401k. So you optimize for that qualified business income deduction. Some folks are focusing on that tactic. Other folks might say, no, you know what? I'm going to lean into this diminution of the qualified business income deduction. So I'm going to take my full deduction for my solo 401k contribution. And I understand that's going to lower this 20% deduction. But my hope is I'll get to retirement, early retirement, conventional retirement, whatever you might define that as. And then in the distribution phase, or if I do Roth conversions, my hope is I'm still going to be at a lower tax rate than when I was deducting those contributions. So this is one of those things, Joe, that nobody went to school for the qualified business income deduction. But with educational tools and resources like my book, folks can figure this out, right? This is not rocket science. There's no splitting of atoms here. A little complicated, not necessarily intuitive, but very manageable.
But it is interesting that you may be losing a deduction by going pre-tax, and you just need to factor that in, that if you decide to make this a pre-tax contribution, you might be screwing yourself and you don't even know it.
That's right. So part of what I'm trying to do with the book is just raise awareness, right?
Yeah.
You should understand all the consequences of doing a solo 401k, the benefits and the drawbacks. And then I'll also mention too, for our higher earning professionals out there who are solopreneurs, the flip of this situation could be true. It could be true that the solo 401k deduction actually opens back up the qualified business income deduction. You start to lose it in many cases at higher earnings levels. And so for some folks, it's going to actually make more sense to do those traditional deductible contributions. As your income rises, you lose, in many cases, that qualified business income deduction. And you can open back that door by deducting solo 401k contributions, where you're not only getting that solo 401k deduction, you're also increasing your qualified business income deduction.
Guys, those are all the questions that I have for Sean. But I know that you've got some, and I want to make sure that this is what I love about doing this on Fireside, is that we got the man right here, and you can ask him questions from the book. The book, by the way, is Solo 401k, number one. It's just so cool to say. It's just awesome. I mean, opening a new at number one as the new release, the Solopreneur's Retirement Account, Solo 401k, available, Sean, everywhere. Amazon, where do we get it?
Amazon, Barnes and Noble, I'm pretty sure Apple, all these online platforms that frankly I'm not all that familiar with, but yeah, for a lot of folks, it's the e-version of the book. So go get that. That's fantastic. Today, it's a number one new release on Amazon. Tomorrow, it's John Grisham. So watch out. No, I'm just kidding. But I'm honored that so many folks are thinking about this stuff and thinking about using me as an educational resource.
Absolutely fabulous. We're going to start with the question here. By the way, if you're on YouTube and you want to ask your question to Sean yourself, you could be here in the audience. Make sure you download the app. You'll see that we're live right now. And I think there's 2 shows live right now. There was when we started. Just click on it and then request to speak. Like our friend Chris, I think maybe has a question for you. So I think we're going to start here. Chris, are you there?
Yes, sir. How are you?
God, you just have the golden voice, man. Every time I hear Chris, Sean, I'm like, I would burn my voice if I had his.
It came with the birth certificate. I had nothing to do.
It was an add-on, right? Yeah.
Yes. I was born and I said, "Mommy, feed me." Yes.
You got a question for Sean?
I sure do. Let me couch this question as they say. This is not about me. Wink, wink, nudge, nudge.
Right.
What
for
if
a hypothetical friend? Yeah.
Yeah, I'm asking for a friend. What if you, in your life experience, did all the corporate stuff, had the 401ks, cashed them out because of financial crises situations, paid the penalty, spent the money, bought the T-shirt, sold it at the garage sale. All right. So you're now at retirement age, 66. Like I said, this is not about me. Is there something you could advise somebody, I don't want to say starting over, but somebody who really needs to prepare in their older age? Is there hope, my friend? Thank you.
And you are, Chris, you are self-employed though, right?
I'm self-employed, pretty much, yeah.
Yeah. Yep. And Chris, by the way, has a great show here, which is the antidepressant of the day, which is a great show. But Sean, somebody starting off at retirement age.
Yeah, a few points on that. Great question. First thing I would do in a situation like that is I'd go to ssa.gov, right? So almost all Americans are annuitants, whether we realize it or not, right? Social Security is there. And what I would do is I'd start by pulling my personal Social Security statement and seeing what your benefits could look like at full retirement age and maybe doing some projections around that, right? That's a big source of revenue for so many retired Americans. Doesn't get enough attention in the personal finance space, right? That's the first thing. The second thing from a tax planning perspective is there's tax planning and there's sufficiency, right? If we're thinking, you know what, in retirement, we may have sufficiency problems, then I think sufficiency needs to take over for tax planning, but it still can be very good news from a tax planning perspective. So what do I mean by that? If I'm in a situation where I'm a little later in life and I think I'm getting a late start or things just haven't worked out the way I'd hoped they would, what I would generally be doing, and look, every person needs to make their own analysis, but as a general principle, I would be pocketing those deductions today. So I would be deduct. Roth is a great idea, but it may not be right for your circumstances. So what are you doing? Maybe you're later in your career, so you're doing well from an income perspective, right? You're at your higher earning years, but the assets, the balance sheet for retirement doesn't look so good. So why don't we do this? Why don't we deduct, get money into those 401ks, whatever we can do. And then in retirement, one of two things is going to happen. Will barely be sufficient, and we'll have to take Social Security and 401k distributions, but our balance sheet won't be huge. It'll be sufficient, but not great. So we'll never pay a high rate of tax the rest of our life because our income is just not going to be that high. So what we've done is we've secured tax deductions early or during our working years before retirement. We max those things out. And then when we flip back into taxable income, guess what, right? It's not going to be taxed at that high of a rate because we have these progressive tax brackets, the 10% bracket, 12% bracket, and so on. So I think that's the both the sufficiency and the tax planning play. There's a lot of hope there. The government's essentially providing you a subsidy, but that also points to, hey, you probably shouldn't be doing Roth planning. And look, if things go really well in the next few years and the 401k grows, well, all right, now you may have a little bit of a tax problem, but that's still way better than having a sufficiency problem.
And I also think to add on to what Sean says, and I can't find, people watching us can see that I've been typing furiously because I'm trying to find this great woman's name. There is a couple, Sean, that I met at a Camp Phi. And by the way, Camp Phi is this great thing where you go for a weekend and you really talk about your values. These are just wonderful retreats. But there's a woman, I think her name was Beverly.
It's Becky Heptig.
Becky Heptig. And Stephen, there it is. That's exactly. Yes. You know what? Yes. But this is interesting, Chris, for motivation. If you find a way to hear their story, I know she's been on our show, on the Stacking Benjamins podcast. She was also on the Choose FI podcast. And if you just look up Becky Heptig, Hepteig, I think, and put her in the search of either Stacking Benjamins or Choose FI, you'll find her telling her great story, or her and her husband telling their great story, which is they started really late and thought they were screwed, and they made it. And so for motivation, I would say listen to Becky's story, because she's got Sean a great story. Like, that's phenomenal.
Absolutely. And I believe if you look in Facebook, and I myself am not the most nimble Facebook person, but I think it's started at 50. That's their Facebook group. And so that'll link to their blog and stuff like that. So Becky Heptig, starting at 50, is just a great resource, Joe. That's a great point.
Yeah. I see it right here. Started at 50. Great people, just super people. Chris, thanks for the question.
Well, thank you both so much. I'll be sure to tell the person who wanted me to ask the question.
Yeah, absolutely. Pass that along.
Yeah. And I'm so glad it was in our wedding vows 36 years ago, for better or worse or sufficiency. Thank you so much.
Thank you, Chris. That's so awesome. I got a question from YouTube that Karen, our producer, just sent me, which is there a minimum amount of money I need to make in my business to put money in a solo 401k? Is there a point where it really makes sense? Is there a crossover point?
Really good question. So in order to have a solo 401k, you need a trader business. You need self-employment income. At the lower levels, it's just not going to make a whole lot of sense. So you want to avoid things like, I'm a stamp collector and I sell 5 stamps a year and there's some profit from that. That's taxable income, but almost certainly not self-employment income. So you probably can't do a solo 401k for that. I think in terms of when does this start to make some sense, I think probably maybe something like 4 figures of income, right? Nobody needs to be Apple computers or even the Stacking Benjamins podcast in terms of business activity to open a solo 401k, but you can't do it for a hobby. And for for something that's very, very small, the tax juice isn't going to be worth the squeeze.
Question from Kevin. What about employing your kids? Are they allowed to be employees and still qualify for a solo 401k per law?
So this goes back to that tax rule issue and the plan rule issue. So what can happen is they can be employees for under 1,000 hours, under 500 for the 3 years starting in 2024. And as long as that's true, the owner of the business can still have his or her solo 401k. However, you got to look at the plan rules, right? So some people get fouled up by this. If you employ the child for an hour a year doing, maintenance work, doing custodial work, that sort of thing, you could blow your own solo 401k. So that's a
Mm.
little bit of an issue. And then generally speaking, no, the solo 401k doesn't obtain to the kids, right? So if mom and dad have self-employment, they themselves could do the solo 401k. But if they want to add the kids, they have to adopt an actual 401k plan, which is going to be a whole much more of a heavy lift. You become an ERISA trustee, totally different conversation than today's fireside chat.
It's funny how two things couldn't be more different. A solo 401k and a 401k, like just
the back end stuff, the stuff we like to avoid. The solo 401k is so nice because it gets us away from, they call them these anti-discrimination rules, right? So the book is 200 pages. If I had written about the anti-discrimination rules, it probably would have been 600 pages, right? So that's part of the reason we like the solo 401k.
Solo 401k, by the way, is on a calendar year basis, right? I mean, December 31st, contributions in. And I mean, if I set it up by the 31st and can put a contribution in at the end of the year, can I do that? Or is there a different cutoff to setting it up?
So there's a little bit of a different cutoff depending on employee or employer. The nice thing about the solo 401k is, well, two things. One, for the employer contribution, you can actually set it up after year end, not the employee though. And then two, if you take some affirmative steps, even on the employee contribution, when you're a Schedule C solopreneur, you can make an election and then fund it after year end. So that's a nice feature for those who work out of an S corporation. The employee stuff has to be by year end. So
Gotcha.
yeah. So it can vary, Joe. I talk about deadlines in the book, but there is some flexibility in terms of cash flow, especially if you're a Schedule C solopreneur.
Last question. I got a heart out. I've got to hit the road. And we've taken up enough of Sean's time. He's got other avenues to make sure the word gets out about solo 401ks. But Jody asked this one I thought was pretty good, Sean, which is she has W-2 income, so she can set it and forget it, right? To use your rump appeal language from the top of the show. Her husband, though, works for himself. They can't afford to even max out her 401k right now. There's just not enough money to do that. So do they set up the solo 401k? Is it worth setting it up, or do they just pile money into her set it and forget it plan?
So look, I don't know the investment choices in her plan, but purely a tax play here, it may be the case that because of that qualified business income deduction, the better play is to contribute to the wife's 401k at work. Right? Because that doesn't suffer from any diminution of that qualified business income deduction. So it depends on their income level and things like that. But let's just say they qualify for the full qualified business income deduction. The optimal play from a purely tax standpoint might be plow as much into the deductible 401k at the large employer and then maybe forego the solo 401k. That's okay. Maybe the solo 401k isn't the tool in the toolbox this year or even next year, but maybe in 2024, maybe in 2025, right? This isn't about, hey, what's the outcome today? It's about minimizing total lifetime taxation and getting us to our ultimate financial goals, not necessarily maxing out any one year's tax deduction.
Fantastic, my friend. As usual, you brought it today for us. Thank you. Thank you so much. Congratulations on the hit book. The book is Solo 401k, and it's available Amazon, wherever finer books are sold. By the way, if somebody wants to get a hold of you specifically outside the book, give us your contact info. Where's the best place for people to find you, Sean?
Yeah, you can find me on my personal finance blog, FITaxGuy.com. On Twitter, Sean Money and Tax, and my financial planning firm website, MullaneyFinancial.com.
Guys, thanks for hanging out with us. I'm so happy to be back on Facebook. On Fireside. Wow. I've been on Facebook for a while. I'm not usually happy about it either, Sean. I'm much happier being here. Tomorrow, I'm going to be here with Steve Kerber from, you know how, Sean, on your electrical things like a lamp, there's that little tag and it says UL listed. I've got Steve Kerber from Fire Safety Research Institute, which is UL. It is the UL people that take care of that. I'm fire safety. So your family fire plan. So we're going from solopreneurs today to working on your fire safety plan tomorrow, which is why it's fun doing what we do.